Many people think the global economy is resilient and that traditional portfolios will protect their wealth through any upcoming turbulence. But not everyone sees it that way. In his annual shareholder letter just released a few days ago, the chief executive of the world's largest bank bypassed the usual corporate optimism to warn of a devastating economic scenario. Jamie Dimon is preparing JPMorgan Chase for a financial crisis that destroys both stocks and bonds simultaneously. And today we break down the mechanics of stagflation, the hidden private credit bubble, and why the safe haven myth just broke. My name is Nick, and this is Coin Bureau Finance. For the past 4 decades, ordinary investors and massive pension funds alike have relied heavily on the classic 60-40 portfolio allocation model. This strategy places 60% of a capital into equities for growth and 40% into fixed income government bonds for security. And the foundation of the strategy relies on a negative correlation between those two distinct asset classes. Under normal macroeconomic conditions, when economic growth slows and stock prices fall, investors naturally flee toward the safety of government debt. And that sudden flight to safety pushes bond prices up, effectively acting as an automatic parachute that stabilizes the overall value of the portfolio. And you can think of it as a perfectly balanced financial seesaw that ensures your retirement account never suffers a catastrophic drawdown. And this inverse relationship has allowed generations of investors to sleep soundly through various cyclical recessions. From approximately 1980 to 2021, this correlation between stocks and bonds averaged around negative 0.4, and this reliable metric was the absolute engine of diversification that financial advisors sold to the public. Central banks supported this dynamic by reliably cutting interest rates whenever the economy showed signs of weakness, all but guaranteeing that bond yields would fall and bond prices would rise during any significant equity market panic. Meanwhile, the institutions managing these assets grew to unprecedented proportions during this 4-decade period of highly predictable market behavior. And JPMorgan Chase, for example, currently holds $4.425 trillion in total assets, putting it near the top of the global financial pyramid. So, when an institution of that scale identifies a structural flaw in the macroeconomic plumbing, the financial world is forced to pay close attention. You see, the entire wealth management industry essentially built its business model on the assumption that inflation was a beast that had to be tamed. But that assumption requires a world in which supply chains function perfectly and geopolitical conflicts remain relatively isolated. And that's not the world we live in today. Perhaps unsurprisingly, given the world we live in right now, the 60-40 portfolio experienced its worst annual performance in 150 years back in 2022. It took until June 2025 for that balanced allocation model to finally recover to previous highs, proving just how devastating a positive correlation can be for retirement accounts. And that brings us directly to the unprecedented disruption detailed in the 2026 JPMorgan shareholder letter. The CEO, Jamie Dimon, bypassed standard recession fears to point toward a structural regime change in how money actually works. And he actually referred to sticky inflation as the skunk at the party for the year of 2026. He actually warned that this persistent inflationary pressure could actually go up rather than slowly down to the central bank target. And he explicitly tied this structural inflation to the ongoing conflict in Iran and the resulting fracture of global supply chains. With the blockade of the Strait of Hormuz disrupting the transit of global energy supplies, Brent crude oil spiked to roughly $119 per barrel in April. This geopolitical wildcard is creating severe commodity shocks that ripple through everything from agriculture fertilizer to basic transportation costs. Dimon drew historical parallels to the deep recessions of 1974 and 1982, which were primarily driven by the exact same combination of rapidly increasing oil prices and persistent inflation. During that historical period, the stock market lost significant real purchasing power, while bonds actually performed even worse because rising inflation eroded fixed income payments. And this specific macroeconomic cocktail creates the scenario known as stagflation. characterized by low economic growth and high consumer prices, the worst of both worlds. In a stagflationary environment, the negative correlation that protects the traditional investment portfolio completely breaks down. Because inflation remains elevated, central banks cannot cut interest rates to save the falling stock market, but interest rates act like gravity on all asset prices, compressing the valuation multiples of equities while simultaneously destroying the value of fixed income bonds. And we're already witnessing this exact breakdown in real time across the global financial markets. The 10-year United States Treasury yield recently surged to 4.37%, while the yield curve has completely normalized from its previous inversion, with the spread between the 10-year and the 2-year Treasury notes returning to a positive term premium. And this technical shift indicates that bond traders are demanding significant compensation to lend money over longer periods of time, which is entirely consistent with expectations of persistent structural inflation. As a direct consequence, long-duration Treasury bond funds lost more than 2% of their value in a single month. Simultaneously, the S&P 500 index dropped by roughly 3.6% since the start of the year. Both asset classes are now falling in tandem because the market fears persistent inflation rather than a standard deflationary slowdown. The correlation between bonds and stocks has violently flipped to a positive 60%, meaning they are now reinforcing each other's decline. Now, while retail investors entered the year expecting multiple Federal Reserve rate cuts, the institutional reality has violently shifted. In January, the market was optimistically pricing in at least 2 rate reductions for the calendar year. But as the consumer price index remains stubbornly above the target rate, those expectations collapsed. The market is currently pricing in 0 rate cuts for the remainder of 2026, and some analysts suggest we might not see relief until late 2027. So, the era of easy money and predictable safe havens has been permanently shattered by these moving tectonic plates. But before we dive deeper into the hidden vulnerabilities of the shadow banking sector and how the stagflationary trap will directly impact your cost of living, if you want to stay informed, make better investment decisions, and avoid being blindsided by structural inflation shocks like the ones we're covering today, then you should be reading the Coin Bureau Finance newsletter. It is absolutely free, and we break down everything regarding global markets, commodity markets, macroeconomic trends, and monetary policy so that you never miss what truly matters. All you have to do is click the link in the description or scan this QR code on the right of your screen to get started. And now, back to the hidden dangers exposed in the shareholder letter, in which Dimon also exposes a vulnerability that Wall Street is desperately trying to ignore. He explicitly warns that losses in the unregulated private credit market will be significantly higher than those expected due to years of loose underwriting. This rapidly expanding shadow banking sector currently holds an estimated $1.8 trillion in assets under management. Unlike the transparent public bond markets, these corporate loans are highly illiquid, unrated by traditional agencies, and severely lack rigorous valuation marks. For the past decade, alternative asset managers have flooded the space, offering loans to mid-market companies with incredibly aggressive assumptions about future performance. But the underlying financial health of these corporate borrowers has deteriorated to an alarming degree over the past 2 years. The median interest coverage ratio for private credit borrowers has collapsed to a precarious 1.6 times earnings. And that means nearly half of these companies are generating barely enough cash flow to cover the interest payments on their outstanding debt. And to make matters worse, approximately 70% of all new private credit issuance is now classified as, quote, covenant light, meaning these loans strip away the early warning triggers that historically allowed lenders to intervene before a borrower collapsed. Because of these deteriorating standards, analysts at Morgan Stanley project that private credit default rates could surge to 8% between late 2026 and early 2027. And that projected failure rate hits well above the historical average of 2.5%, confirming Dimon's warnings that losses will vastly exceed expectations. And to mask this creeping insolvency, lenders have increasingly relied on payment-in-kind provisions, which allow struggling borrowers to pay their interest using additional debt instead of actual cash. And this creates a dangerous illusion of stability by generating phantom income on the accounting ledgers while no actual liquidity enters the system. And this phantom income now accounts for nearly 10% of total investment earnings for major business development companies. And indeed, Dimon previously highlighted this exact systemic rot during an October 2025 earnings call, following the bankruptcies of several subprime lenders. He famously stated that when you see one cockroach in the financial system, there are probably many more hiding behind the walls. And those early defaults were not isolated incidents, but rather the initial symptoms of a much broader deterioration in credit quality. And this brings us nicely to the severe liquidity crisis currently unfolding across the largest funds in the industry. In the first quarter of 2026, BlackRock's $26 billion corporate lending fund faced an unprecedented surge in redemption requests. Nervous retail investors attempted to pull approximately $1.2 billion out of the vehicle in a single quarter. And because the underlying corporate loans cannot be quickly sold without taking devastating financial haircuts, the asset manager was forced to activate an emergency gating mechanism. They capped the withdrawals at their strict 5% limit, fulfilling only a fraction of the requests and leaving hundreds of millions of dollars completely trapped. And this classic contagion phenomenon quickly spread across the industry, with other major alternative asset managers facing similar surges in withdrawal requests. When these highly illiquid loans inevitably default at scale, the contagion will spill over into the broader economy, and the most terrifying contagion channel runs directly through the balance sheets of major insurance companies. United States life and annuity insurers have doubled their exposure to these opaque corporate loans over the past decade. And these alternative assets now account for roughly 35% of total investments for the domestic insurance industry. Dimon predicts that insurance regulators will eventually demand stricter ratings and capital markdowns on these deteriorating portfolios, and when that intervention occurs, it will trigger mandatory capital calls and forced asset sales, creating a slow and grinding erosion of retirement security for millions of pension holders. Furthermore, an estimated 26% of direct lending portfolios are heavily concentrated in software and technology companies. Generative AI is currently disrupting the subscription business models of these exact borrowers, threatening their cash flows and underlying collateral values. And this technology disruption is compounding the macroeconomic pressure of elevated interest rates, creating a perfect storm for widespread corporate defaults. And this macroeconomic transmission mechanism creates a profound paradox that is tearing the middle class apart. We are witnessing the rapid emergence of a two-speed economy, where the headline index numbers completely mask the underlying domestic deterioration. On the one side of this economic divide, hyperscaler capital expenditure for AI infrastructure is driving astronomical corporate profits. The top 5 tech giants are projected to spend nearly $700 billion on data centers and specialized semiconductors in 2026 alone. And this near doubling of capital investment represents a worrying concentration of wealth within a highly exclusive sector of the market. These few tech monopolies are effectively pulling the entire equity index upward, creating a dangerous illusion of widespread economic prosperity. On the other side of the divide, meanwhile, the labor market for the average citizen is experiencing a severe and undeniable contraction. According to recent workforce analytics data, entry-level job postings have plummeted by an astonishing 35% since January 2023. Companies are aggressively cutting junior roles and halting training programs as economic uncertainty and automation technologies reshape their hiring practices. Simultaneously, the average consumer is being crushed by non-negotiable expenses that central banks cannot really control. The energy sector ETF has surged by nearly 30% since the beginning of the year, directly reflecting the rising costs of fuel and transportation. Meanwhile, the consumer discretionary sector has plummeted by over 8%, proving that working families are aggressively cutting back on non-essential purchases. The financial squeeze is being severely exacerbated by the silent tax of skyrocketing insurance premiums across the country. Home insurance costs have surged by roughly 46% since 2021, vastly outpacing the official headline inflation metrics reported by the government. Diesel prices have also climbed significantly, operating as a direct cost of living penalty that inflates the price of every single product delivered at a grocery store. Furthermore, 30-year mortgage rates have surged back toward the 6.5% threshold, effectively paralyzing the housing market and locking first-time buyers out of the American dream. The cost of financing past government spending has also reached a critical tipping point that threatens the foundation of the entire fiat system. The US national debt recently crossed the $39 trillion threshold, and the annual interest payments required just to service that burden have now eclipsed the entire national defense budget. This fiscal dominance guarantees that the government will continue to inject newly printed currency into the economy, establishing a permanent floor under consumer prices. Meanwhile, the Fed is effectively powerless to intervene, given the interest rate dilemma it now finds itself in. So, the smartest institutional money is no longer waiting for a miraculous soft landing engineered by government bureaucrats. Instead, elite asset managers are aggressively positioning their portfolios for a prolonged period of wealth destruction and structural volatility. Analysts describe this emergent scenario as a triple red scenario, where equities, bonds, and currency all fall simultaneously. And this represents the rarest and most destructive environment for wealth preservation in modern financial history. Institutions are rotating capital into hard assets, commodities, and critical infrastructure, while the general public remains entirely exposed to the failing 60-40 financial model. The global financial system is experiencing a paradigm shift. The era of frictionless international trade, easy monetary policy, and predictable safe havens is over. And when the chief executive of the world's largest banking institution publicly warns that the traditional illusion of safety is gone, ordinary investors need to pay very close attention. The macroeconomic indicators are screaming that we have officially entered a stagflationary trap where historical portfolio defense mechanisms simply stop working. And if you're wondering who ultimately ends up paying the price for all of this, then just take a look in the mirror. But what do you reckon about this unprecedented macroeconomic shift? Can the Fed successfully navigate this stagflationary trap? Or is this devastating correction in both stocks and bonds inevitable? Let us know your thoughts in the comments down below. And if you want to understand how the world's largest asset manager is positioning for this exact scenario, check out our video on Larry Fink's secret agenda right over here. That's all from me today. As always, thank you guys very much for watching, and I'll see you again soon. This is Nick, signing off.